Hello guys, welcome to a new video. Today I would like to share with you what is it that I look in stocks before buying them, and so basically we will be looking into how do I analyze a stock. Today I will not extend on the introduction, so let's jump right into the topic. The first thing I do is to check what the company does. At first this might sound stupid, but of course if we're talking about companies such as Coca-Cola or maybe Johnson & Johnson and so on, it is very obvious what they do and many people know that. But in the stock market there are thousands of other companies that their names are not really representative of what they do. So what I always do, well, especially at the beginning when you're starting to get started in the stock market, is check what is it that each company does. When I have clear what is it that they do, I try to picture which are their future perspectives. And I just want to mention that I'm no guru or anything, I don't know the future, and I would dare to say that nobody does, but what I just think is whether I am using this product or I feel that this product is used at the moment, and whether it will also continue to be used in the future. For instance, in my opinion, the whole aerospace industry has a lot of potential because planes and rockets, I include both in my opinion, are a much faster alternative than cars or other transportation means. Of course, we still need to work on the power sources of these planes and rockets and so on, but they are just a much better alternative and an industry with a lot of potential long term. Or, as I also already mentioned in another video, renewable energies to me are also the future, and also if we want to power planes or other means of transportation with clean energy, we really need to work as well on renewable energies. But then there are other companies, such as for instance the ones that produce office materials, such as pens, papers and things like that in my opinion they don't have a very bright future ahead of them. Mainly because everything now is going online, and actually me personally, I don't even remember the last time I bought a pen or some papers, which was probably a really long time ago, and now everyone in schools or universities are starting to just use their laptops to take notes at school. So in my opinion this industry is really going down. But as I said, these are just examples of what I think. And I think that it's also important at this point to highlight that I'm no financial advisor, of course. I'm just a guy who is very passionate about stocks and likes to talk to a camera about them. But just make sure that you create your own investing strategy when investing in the stock market. So just to leave this first point very clear, in general, if I don't really like what the company does or their future perspectives, I stop looking at any more things at this point. But if I like it, I keep on going with the analysis. And I would like to remind you at this point that I would greatly appreciate if you could just hit that like button which is just here below. With that, I'm happy. I mean, if you even subscribe to the channel, because 72% of the people who watch my videos are not subscribed, which is a massive amount of people, I would greatly appreciate that. Thank you. That said, the second thing I look in a stock is whether it pays dividends. Because if it doesn't pay dividends, I'm very unlikely to invest in them, since as you know, I'm a dividend investor. For me to invest in a non-dividend company, I really need to think that they will revolutionize the world in the future, or at least that maybe in the future they will start paying a dividend. Okay, but if they pay dividends, I'm looking for yields above 3% yearly, and ideally, of course, with low payout ratios. Because something that happens with some companies that try to keep their investors very happy by paying dividends is that they have such high payout ratios, sometimes even above 100% when things are going bad like at the moment, which basically means that they are paying more dividends than what the company is earning with their operations, which is of course not sustainable, and instead of, it just damaging the company. Therefore, it is as important to check the dividend yield as the payout ratio, because if they have a low payout ratio, they have a lot of room to keep growing their dividends, while if they have a very high payout ratio already, their room to increase the dividends is very limited. After that comes the next step, which is to check the debt ratio of the company. This can be expressed in different ways, but an easy way to do so is to go to Yahoo Finance or to the investors site of the official website of the company and to check their last balance sheet. This is displayed in their end of the year results or in the different quarters. Then it is as simple as dividing the total liabilities they have over the assets. And this basically gives you a percentage. Many people will tell you different things on what is considered to be a good debt ratio, a bad debt ratio, and so on, but in general it's very hard to say this because it depends a lot on the industry and each company in particular. But to keep it simple, the lower the debt ratio, the less risky the company is, because if suddenly the company has to stop their operations, like it happened just now, the company doesn't have to pay back money to so many people, and therefore it should be easier for the company to survive. While on the other hand, if the company has a high debt ratio and suddenly it stops generating cash flow from their activity, it means that it has to still pay back money to many different people, which makes it much more likely to go bankrupt. In my opinion, and very generally, a debt ratio below 50% is considered low risk. At 65%, I consider it conservative, and above 75–80%, I consider it risky. But as I said, it all depends. Because you may have a company such as Nordic American Tankers, there was a lot of talking around it, but if you don't know, they basically transport oil, so gasoline, through the sea. And they have tankers for that. And in this company they have a very low debt ratio of only 43%, so we could say that on this side it is low risk, but then on the other hand it has had major losses for many consecutive years, and also the future perspectives are not so good. But then you have a company such as Boeing, which has a debt ratio above 90% that you would say, wow, that's super high, maybe let's stay away from it. That is in a very good industry with a lot of potential, at least in my opinion, the aerospace industry, and with very good future perspectives. But one thing that makes Boeing not such a risk investment is that the US government has publicly said that it will do anything to make sure that Boeing doesn't go bankrupt. Which means that although they have a very high debt ratio, the US government will keep putting money inside the company no matter what. So again, the debt ratio is not the only measure to take into account. Now we will discuss some other things, but it is definitely an important one, especially in the current times. The next thing I check, and that I actually somehow already started mentioning, are the profits. And to do this, you can also again go to Yahoo Finance on the part of income statement, or you can also go to the official website on the investor side and check their income statement. For me, Yahoo Finance is a pretty easy to use tool because it displays automatically the results there, and I don't have to keep looking at so many websites, and sometimes the investor sites of companies are not very well designed, to be fair, so Yahoo Finance is a pretty good option. And what I basically do is to check the profits that they display of the last 4 years, and I check whether they have been more or less stable, whether they have been increasing, which is very good of course, maybe they have been decreasing, or maybe they have even had losses. And just what I do is I basically write in my Excel this trend that they are facing, or which years they have had losses, and so on. Okay, so once I do this, I mainly have 3 metrics, because as I said at the beginning, if the company was not interesting, I stop looking any further. And these 3 metrics are, first, the dividend yield, and I also include here the payout ratio, then we have the debt ratio, and then we have the P&L history, so the profit and losses of the company. And at this point it's about balancing these 3 aspects, and it depends a lot on the time the economy is facing, on whether you will place more importance on one or the other. In the current moment, with the crisis and so on, I think that a very important metric to check is the balance sheet, to make sure that they have a low debt ratio, in order to make sure that they can sustain periods in which they don't have that much cash flow coming in, or maybe they don't have cash flow at all. But again, each company is different, because as we saw in the case of Boeing, they are backed up by the government, so it really doesn't matter that their balance sheet looks horrible, because they are still backed up by one of the most powerful economies in the world, if not the most powerful one. But also something that I would advise to check would be the news, and also the investors' side on what is it that the company has been up to, and which are their future plans for it. But let's say that I analyze the company and I like the metrics that I just shared with you. This means that to me this company is interesting and that I would like to invest in it. But this does not mean that I'm going and I'm just straight away buying the company no matter the price and so on. No. This just means that this company becomes part of my Excel sheet of companies that I would like to buy. Now it's when I go and check which is the price at the moment of the stock and which has been the historic price and the evolution and so on. And as you can see, this is one of the last things I do, while for many people this is one of the first ones. And this is because I'm much more interested as a long-term investor in the core business of the company and how it is doing in reality and not in the stock market, which is just speculation between supply and demand. But going back again to the price of the stock, here what I check is basically whether the stock has been clearly uptrending throughout time. So maybe in the last 30 years it has always followed a line uptrending, which is the case in most of the companies of the S&P 500 in the US. Not the case if you look, for instance, in the Spanish market, the IBEX 35. It's quite horrible because it's just been trending, sideways. But this is also important to check. For me, seeing a company that has a clear uptrend throughout history, although of course there are always ups and downs, is a very good sign, because it shows that the company has been performing well throughout time and that investors are interested in it. If we take, for instance, the graph of Johnson & Johnson, it is the perfect example of a company that has been clearly uptrending throughout time. And actually, I even made a video in which I share with you which would be your current return just on dividends if you had bought this company 26 years ago and you were still holding it today. It would have been a great investment. But on the other hand, we have other companies such as, for instance, Nordic American Tankers, in which we see that the stock price has been doing maybe sideways, and now throughout the past year it has been going down, which is really not very good. After this, I also like to check the price to earnings ratio of the company. And what this basically tells you is that how many times this company is trading the earnings that it is making per each share it has. To check it, I go to the website Market Screener on the financials section, and then if you scroll down a bit on the side, you have a graph that displays which has been the average price to earnings ratio for the past, if I'm not wrong, 10 years. For instance, for the company PepsiCo, they have been trading on average at 21.8 times earnings per share. Which means that ideally, when you buy this stock, you would want to buy it at 21.8 times earnings or less to see that whether this stock at the moment is more overvalued or undervalued. And this is also a good metric in order to predict the price of the stock in the future, because usually companies, when they do their annual meetings and so on, they display which are the future perspectives of their business in terms of earnings per share in the next maybe 1-2 years, or in many different years. And then what you can do is take the price to earning ratio that they have had on average and multiply it by the earnings per share that they expect in the future. Hopefully it's more than now. And then you can get to the stock price that you will get in maybe 2 years or 3. Again, it doesn't mean that this will happen, because things like the current situation that we are all facing right now happen, then these forecasts might not be met, and then all the calculations might be of nothing, but it's just a good metric to have kind of an idea. So based on this, the historical price of the stock and the future perspectives as well, based on checking news and so on, and what the company is doing, I write down a price at which I would like to purchase the stock. And something I can tell you is that if you're a long-term investor and you have done your analysis, whether it's this or your own analysis and so on, and you have set yourself a price that you would like to purchase this stock at, respect it, please, respect it. Because what happened to me is that when the market started crashing in March this year, I had done my analysis, I had, placed my orders and so on, but I kept seeing that the market was crashing and crashing, so what I did was to keep lowering my orders to try to buy at a cheaper price, and guess what happened? There were companies that I finally ended up buying at a cheaper price, but then there were others that, because I was trying to be too greedy and try to get the bottom of it, I ended up not buying just because I wanted to buy them at 20% less maybe of what I had initially set as a buying price. So from my experience, please respect your analysis and the price that you set, because you have spent some time doing this research and everything, so just don't blow it all away and respect it. That then the stock keeps decreasing in price. No problem, you can add more to your position, but don't miss out on good opportunities to try to get even better ones. And this is what I feel that happened to many investors. They did not get in the market when the prices were pretty attractive in my opinion, hoping that they would go lower or whatever, and basically they already missed out on the opportunity and now they are regretting it every day, especially after seeing that the stock market has gone up, I don't know, 30-40% to all-time highs again. Personally, I entered some positions that I just mentioned at that time, so I am very happy for that. Of course, if I had known that what the stock market would do, I would have added much more to my positions, but this is something that no one can predict, so I'm pretty happy on how I did things, except for the fact that I didn't respect many of my buying orders. And it was not just me or many people who couldn't predict this, even Warren Buffett himself, he made some questionable moves during this crash that I think that have not been very well seen by the whole stock market investing community and so on. Well, that was it. These are the main things I check before buying a stock, and I just hope that you got inspired in some way, whether it's to adapt or to add an extra metric to the already current analysis that you are doing on your stocks. As always, you know my opinion, the best thing is to invest long term. Also to like the video and subscribe to the channel. Thank you so much and see you next time.